If you look at money growth on a year-over-year basis, it was negative for, I think, about a year and a half, maybe more. Money is a leading indicator for inflation, and we do believe that inflation will go much lower than people expect right now. Wouldn't be surprised to see it go negative, especially if the consumer is worried about job loss, whether because of AI and automation generally, or what have you. So the saving rate tends to go up during those periods, and that will mean, we believe, that companies will have to price even more aggressively.
On Friday, the U.S. Labor Department reported that 254,000 jobs were added by employers in September, more than 100,000 jobs higher than LSEG economists had predicted. The unemployment rate also declined to 4.1%, and the number of jobs added in July and August were revised upward. Jobs creation in July was revised upward from 89,000 to 144,000, while that of August was revised upward from 142,000 to 159,000. Following the report, renowned American economist and former Treasury Secretary Larry Summers made a social media post, commenting on how the jobs report is an indication of the mistake the Fed made by cutting rates by 50 basis points in September. His post reads, "Today's employment report confirms suspicions that we are in a high neutral rate environment where responsible monetary policy requires caution in rate cutting." With the benefit of hindsight, the 50 basis point cut in September was a mistake, though not one of great consequence. With this data, no landing, as well as hard landing, is a risk the Federal Reserve has to reckon with. Nominal wage growth remains well above pre-COVID levels, and it does not appear to be decelerating. According to analysts, this is the first time the jobs report beat expectations since May, and like Summers, many are questioning whether the Fed's 50 basis point cut was too aggressive. The better-than-expected jobs report has also dampened the market's expectations for further rate cuts. Before the Labor Department released the report on Friday, markets saw nearly a 50% chance of a 50 basis point cut next month. However, the odds of a 25 basis point cut in November have surged to over 90%. In a recent interview with Bloomberg Television, ARK Invest founder and CEO Cathie shared her views on the Fed rate cut and the jobs report, and discussed her expectations for the U.S. economy in 2025 and beyond. Unlike Summers, Cathie believes the Fed is on the right track, as inflation is no longer the main battle to be conquered. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for the support, and enjoy the video.
Do you think the Fed rate cut was a mistake?
Absolutely not. Not at all. It's been very interesting to watch the revisions in economic activity. Until this report, the revisions in the employment numbers had been down, and they were much weaker than had originally been reported. You know, we look at earnings reports and look at their revenues, and we're seeing a lot of companies showing negative revenues. So, you know, the headline numbers are heavily influenced recently, certainly in terms of some of the upward revisions in personal income by transfer payments, that's government stimulus, and interestingly, dividends. But not, if you look at the economy, the cyclical part of the economy is sick. It's sick. If you look at the sectors in the economy, one by one, they've been falling into a recession, no matter what the headline numbers say. Housing went down immediately when the Fed started raising rates. We're down 20 to 40% still. That's a recession. You've got non-residential construction in recession, autos, very weak.
Cathie, I know it's a backward-looking number, but then what do you make of today's payrolls report? 254,000 jobs added to the economy for the month of September. And that doesn't seem recessionary.
So if you just let me finish, Tim, I'll get to that in 1 minute. So we've got those sectors, and then you've got the small and medium business sector. Their confidence is at 08, 09 levels. And we've got certain pricing measures, certainly the cyclical ones, that have been deflationary, actually. So one thing that I do think is going on that is helping is as prices are coming down and the consumer's getting better and better deals, and they're spending. So I think that is sustaining. You know, a lot of people say real growth causes inflation. In this case, and actually in history, most times if you cut prices, you'll get more activity. The consumer, as long as the labor market hangs in here, and yes, today was very reassuring that way. As long as the labor market hangs in here, and companies like Walmart and Costco and auto companies either increase their discounts or cut their prices, I think the activity will come. And the labor market will continue to hang in. But if they try and jack prices back up, it was very interesting to see FedEx, after turning positive in revenues and then turning negative year over year on revenues, basically saying they're going to use prices to make it up. I think that's going to backfire. And I think during the next year, that many people will understand how deflationary the undercurrents are in the economy. Now, deflation is not always bad. Part of it is because of innovation, technologically enabled innovation. The car prices, EV prices are coming down. Their costs are coming down too. So I think there's a lot of confusion in terms of what's going on out there, because productivity is stronger than expected, giving companies the latitude to cut prices and salvage margins. If that sustains, great.
Cathie has been adamant that the Fed's aggressive rate hike will lead to deflation, a position she has maintained to this day. In her words, the Fed has overdone it with rate cuts and now risks the entire economy going into a period of deflation. The ARK Invest CEO believes the solution is for the central bank to cut fairly significantly as inflation goes negative at some point in 2025. Labor attorney and Foundation Law Group partner Eric Bean agrees with Cathie that the 50 basis point cut was a step in the right direction for the U.S. economy. According to Bean, the higher cut was due to the slowing in the labor market and an increase in unemployment filings. The hope is that, now that inflation is under control, we want to deal with the other side of the Fed mandate and make sure that we're not tanking employment, Bean said, while speaking with Fox News, adding, "I think further cuts, probably more measured than a half point, are what's going to be necessary to prevent there being a significant decline in employment moving forward." Let's get back to Cathie's interview, as she talks further about innovation and how the November elections will drive the development of innovations in the United States.
So our focus is on innovation, and something very important happened this past year. We were very concerned that excessive regulation was driving innovation off our shores, particularly when it came to crypto or digital assets. We've had a very hostile regulator. And the same, I would say, is true of the FTC in terms of denying M&A, because that has prevented a lot of innovative companies from enjoying liquidity events by selling out to bigger companies. I think we're hearing from both candidates that those two jobs are on the line, maybe for that reason. And we're seeing more alignment that innovation solves problems, and so we should not discourage it. So from that point of view, I'm happy to see the bipartisan movement here. We'll favor lower regulations every day when it comes to innovation. I don't think tariffs are a great thing at all for innovation and for economic activity. So there's something on both sides that will give us pause. But the most important thing is the biggest impediments to innovation. We think that we're developing clarity around what's going to happen at the SEC and the FTC. Well, we've been doing research on AI for 10 years now. That's why we were so early into NVIDIA. We've obviously taken it down in most of our portfolios out of the flagship. One of the things that we've been looking for is the next big play. We think NVIDIA is still a fine stock, but in terms of the unexpected out there, we do think it's going to be in the software layers. And as you know, Palantir has become a big position for us in the top 10. UiPath as well, it had a stumble, but it's coming back now. And I think as more and more people understand how well positioned it is, it will do very well. But a lot of the software companies that we think are going to benefit are in the private sector. And I'm thrilled that we have a venture fund. Our purpose here is to democratize venture capital so that for $500, anyone can get access to OpenAI, which is the third largest position, or SpaceX, which is the largest position. But if you look at software, many people say, well, we have so many software companies in the public markets. What do you mean? And what we mean by that is we think that the software world's going to change fairly dramatically. And we're going to see a shift, maybe a share shift away from software as a service towards platform as a service. So think about Palantir and foundation models, and infrastructure as a service, so cloud. And the reason for that is because engineers are going to be made so much more productive, developers so much more productive by OpenAI and Anthropic and xAI and Google and Meta's Llama 3. We're going to see companies customizing their own software, for their own companies, as opposed to just going automatically to, one size fits all software as a service.
The Federal Reserve's stance on monetary policy seems to have shifted dramatically, following stronger than expected labor market data. According to the CME FedWatch tool, the market's expectations for a 50 basis point rate cut in November dropped significantly, from 53% a week ago to around 5% following the latest employment report. The strength in the labor market, highlighted by the addition of 143,000 private sector jobs in September, well above the expected 125,000, suggests that the economy remains resilient. This unexpectedly strong rebound, following a weaker August report, has led some economists to question the need for any rate cuts at all. Paul Ashworth, chief North American economist at Capital Economics, argued in a note that the recent labor data calls into question whether the Fed should consider loosening monetary policy. According to Ashworth, any hopes of a 50 basis point cut are long gone, given the economy's labor market strength. Nella Richardson, chief economist at ADP, echoed this sentiment, noting that the job market's solid performance in September gives pause to previous predictions of a significant slowdown. In this context, any near-term Fed action appears less likely to involve rate cuts, as labor market resilience diminishes the rationale for easing monetary policy. Do you think the Fed will announce another rate cut before the year ends, or will it revert to its hawkish stance? How do you think either decision will affect the markets, especially with the presidential elections just around the corner? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.